Well, happy Friday. Today we're talking about the debt ceiling and what this means for investors. So let's take a look. So I think there's really three things to talk about here. First, we'll talk about how we got here, because I think that sort of matters for this conversation. Then I think we'll move to how serious is this, or how worried should we be? And then finally, sort of what happens if nothing gets done and they don't approve this before the end of the month. So let's just jump into it. In terms of how we got here, it takes maybe just a quick history lesson. If you go back to the early 1900s, if the government needed money for something, they would have to get it approved on a project by project basis through Congress. A good example is the Panama Canal. It's a big project, early 1900s. 1902, the government wanted this approved, and so they went to Congress, and Congress passed it. Eventually, as more and more people came into the country, there's more going on, more projects needing funding, and then World War I started in 1914. So you can imagine there's a whole bunch of projects that need to be approved, and it was difficult logistically for Congress to get together and approve each one, project by project. So in 1917, they introduced the debt ceiling, and they said to the government, hey, you can spend what you need up to this cap, and then, if you need more at that point, let us know. So fast forwarding about 100 years since then, we've had about 100 debt ceiling increases since then. So it's kind of become just a formality, if you will, to have this thing approved and to increase the debt ceiling so we can keep spending and borrowing. The problem is, 10 or 20 years ago, politicians started figuring out how to weaponize this or to use it to hold things hostage while they get some of their own agenda approved or the agenda of their constituents. And so that led to, even in 2011, U.S. debt was downgraded, partly because of people just playing around with this stuff. So it's a serious thing, but at this point, it seems like both sides are sort of locked in. Doesn't look like either one is budging at the moment. We're only halfway through the month of May, so there's still some time here. But as it stands today, we hit the budget ceiling in January. Since then, the Fed has kind of extraordinary measures that they can implement to extend that a little bit. Now we're into May, and by the end of the month, supposedly, we will have not enough dollars to approve to pay all of our expenses. So ultimately, they'll have to decide which ones do get paid and which ones don't, and go from there. There's not really a set process for that. So hopefully, before the end of the month, they come to some kind of agreement, and this doesn't really come to a head. In terms of how serious should we be taking this, we can at least look at prices. We believe, just kind of as a framework for thinking, that there's information in prices. So actually just filmed a video. I'll show you a quick clip from that and then be right back. And I just want to pause and give you a sense of what determines market prices. There's a whole world of investors out there, some of them institutional investors, some of them individual investors. And if you look back at 2021, the daily volume in the markets was $774 billion being traded on a daily basis. I did the math, and that's 3 Elon Musks. So his net worth traded 3 times each day on average during 2021. So there's a lot of data, a lot of trades being placed to help settle on what we believe today's current price should be for any given security. So 3 Elon Musk's worth of data every day. He's lost some wealth since then, so now it takes much more than 3. But a lot of information going into security prices, both stocks and bonds. And so we can actually look at prices of bonds and say, of U.S. government bonds particularly, and say, how are investors viewing this? Are they concerned? Are they not concerned? And we do that by looking at the yield curve. So I want to show you the yield curve of May 3rd. There's not really much to say until I show you the change from the 3rd until the 12th. But this is kind of a standard yield curve, what it looks like. Short-term bonds on the left, and obviously they go longer. And shows you what rate those duration or those term bonds are paying currently. If we overlay the yield curve on May 12th, you can see that short term, that 1 month bond, investors seem to be a little nervous about that. So they're demanding a higher return from a 1 month bond. So they seem to think, hey, there's a case to be made to demand a little bit higher return over the 1 month. So kind of makes sense. This is probably a 1 month problem, but I think equally as important as seeing do they care about this is looking at that long-term spectrum, the long-term end of the spectrum. You can see they look pretty similar. So it doesn't look like investors are expecting this to be a long-term problem. As a compare and contrast, if you think of Greece in 2011, they were in some problems. They had built up their deficit too much, having a hard time paying their bills, and they were introducing these austerity measures to cut back spending. They weren't very extreme at first, and they were getting much more and more extreme, and Greece was not a very fun place to be. There was riots, protests, things like that. And their 10-year bond, so a much longer term bond, went from 15% at the time to, at the beginning of 2011, to in the middle of 2011, about 35%. So investors viewed that as a long-term structural problem for the government of Greece. When you look at this chart here, this does not suggest long-term structural problem to me. It suggests, hey, there's a 1 month, maybe 2 month issue here that we need to be sorting out quickly. So as investors, we believe investors should be long-term in their thinking. So short-term things like this are very difficult to predict. We don't know if they'll come to an agreement or not by the end of the month. The thought is that eventually they would, but if they don't come to one by the end of the month, that certainly could lead to volatility. Volatility is a normal experience for investors. You'd like to see volatility because of changes in the economic backdrop, not because of politicians arguing about things, but volatility itself is a normal part of the investment experience. So the thought would be, if this doesn't get approved by the end of the month, which hopefully it does, that there would be a quick adjustment, but certainly some volatility if it didn't. So that's our thought. We believe in being long-term investors and that this is a short-term problem. So structural adjustments to portfolios may not be necessary. But as always, if you have any questions, feel free to reach out. I know it's concerning when we're seeing this and we're seeing the volatility to go along with it. But we're here for you, and we'll see you next Friday.